Welcome to LK Secure Lending. My name is Todd Shillington, and I'm going to introduce you to a company that is doing something that really no one else in the marketplace is doing. With interest rates as low as really almost 0%, how are we getting high returns and still offering a safe place to put your money? How can you find a company that is offering safety plus high returns in the real estate arena? This is not real estate investing. This is real estate lending. I'm going to be introducing you to the three co-founders of this company. First is Barry Levinson, and we're going to talk a little bit about Barry Levinson's background and what he's done in the past and why this company. Also, Paul Kessler. Next to Paul is Paul's wife, Diana Derich Kessler, and we'll be discussing how and why and where they came from to move forward into this side of the industry. Barry, you and I have worked together in the past, and I've been part of your leadership team. I've seen you do a lot of different really good things in this world. This is not a real estate fund. This is a debt fund that you're going to be talking about. Tell us a little bit about where you came from and why a debt fund.
Sure. Thanks, Todd. So I grew up in banking, was part of a startup bank that's the sixth largest bank in the country, among others. After the crash of 2008, started a real estate acquisition fund, to your point, that bought apartment buildings, mostly in the deep south in the country. Today it's about a $300 million fund. The properties were really good deals with great cash flow. It's called a cap rate in real estate after the crash. And that completely changed by sort of 2018 or so, where real estate had just become, especially commercial properties like apartment buildings, way overpriced by mid to late 2018. So I wanted to start a fund that was far safer for investors. See, in most real estate funds, in most REITs, real estate investment trusts, what happens is when properties are purchased, they're purchased with a bank loan and they're purchased with investor money. So say you buy a property for $10 million and that has a $5 million bank loan and then $5 million of investor equity or investor funds. If that property ever goes down in value, say it goes down all the way to $5 million, well, guess what? Debt has to, by law, be senior to equity. So the bank comes out whole, but those investors will lose their money. So I wanted to put together a fund knowing that real estate was so high that was far, far safer. This is a debt fund. We are the bank. So what we do now is work in that $10 million example, we'll provide that $5 million because we're the bank from our investors. So now if that property were to go down in value, say from 10 to 5, our investors come out 100% whole. It would be the borrower that loses the money. So it's a much, much, much safer fund for investors.
Paul, I know a little bit about your pioneering in the financial markets. Tell us a little bit about that and how that transfers over into why you chose real estate as a place to put some of your money.
Sure. So I spent 30 years on Wall Street financing high-growth companies in biotechnology, drug development, cancer therapeutics, technology and energy, amongst others, including consumer products. And in that time, it was a fantastic experience with very, very high highs and low lows, tremendous volatility. And I felt that a couple of years ago, I was talking to my wife and partner about life in general. I'd be turning 60 years old, and I thought it would be a very good idea to transition to something far more secure, something that I could sleep at night and not have to worry about market volatility. I also felt I'd lived through a couple of big recessions, and I thought navigating the markets from more of a lender perspective in real estate would be far better for us as a family. And we were fortunate to have met Barry Levinson through some banking relationships, and we both had a common a vision, an alignment of interests, which really said, why not be the lender? Why not be the bank? We can lend to real estate, be far more conservative, and at the same time not take the equity risk with markets going up and down as it relates to real estate, but enjoy a higher rate of return than most with short-term lending instruments on predominantly income-producing property.
It's interesting. What I wanted to hear was someone that has really been a risk taker all of his life is now at a point where he says, I've got to figure out how to get into more of a protection mode. And that's kind of really where you are, right?
Absolutely. I mean, I felt that navigating and living through a couple of very big recessions, and also understanding sector rotation in the marketplace, understanding investor sentiment. Certainly the markets have risen dramatically over the last 10 years, and this is fantastic. It's been great for us, but also I recognize that things change. And I didn't really want to wake up to another recession. I certainly did not anticipate COVID. And truthfully, the pivot's been fantastic. I get to sleep at night. We're working really hard to put our investor money to work in these high rates of returns, including, by the way, our money. We've invested in these instruments to a great extent, and we're big believers. We eat our own cooking, and we'll continue to do so.
Right. Oh, that's great. Diana, I have read a lot about you, and I've read about your educational background, and which I want to share with everybody. You're a UCLA alum.
Yes.
You're also a Stanford alum where you got your master's.
Yes.
And you are a Harvard-trained attorney as well.
I am. Yes.
And well, let me ask you, how does that fit with this partnership you've put together?
Well, with my education, I was a lawyer for quite a long time, and as a lawyer, I was involved in many, many transactions, United States-based transactions and international transactions. In my career, I then transitioned into becoming an investor. My husband and I started an investment fund, and as he mentioned, we've invested in many sectors. I've been in the real estate investment, I've been in biotechnology, consumer goods, energy, but also now lending. And out of all the businesses that we've invested in, I think there was always a desire to get out of the roller coaster of investing in the regular businesses that you're not sure exactly when the returns are going to come. And so it was exciting to say, okay, you know what, let's see if we can be on the lender side of safe investing, which we always thought was real estate investing. So when we met Barry, we thought this is the perfect relationship to actually create our philosophy of investing to get safe returns. So not only did we become part of the management team, but we also said, let's also invest. And we wanted to share this investment with others as well, because we would like to grow this fund utilizing our money and our capital, but also those that also wish to have safe returns. It's very exciting for me to have been able to launch this company and see the reality of the safe returns coming regularly. On the one hand, I could put my money in the bank and get, 0% returns right now? Maybe 1% if the bank is a good bank, but mostly right now it's a less than 1% environment. Or I can invest it in LK Secure Lendings and actually get regular returns that are close to 10% a year. What a big difference for me. Now, when one is doing lending like we are doing, there are a lot of details that are involved, and there's a lot of paperwork. It's no different than any investor that goes to buy a house for their family. They have to complete all the paperwork. So every single loan that we do, we try to make sure it's very, very safe. And safety means making sure we get the loan to values, as we've talked about here, but also making sure that all the paperwork is solid, that the borrowers that are going to be paying us the regular interest payments are solid borrowers, and that the real estate is a solid piece of real estate, and that the documents support all of that. So that's where I come in. I try to help out with all the administration and legal side of making sure that we're making very safe loans.
You know, part of what I really liked is that you're trying to make it really safe for investors, and investors really don't have to come in with a big investment in the very beginning. And they can start seeing how transparent you are as a company, the type of decisions you're making on properties. Because I know Barry. You know, I like Barry's thought process that he goes through on things to be able to make sure that the investors are really well taken care of. Once they get comfortable, they can continue to invest with you, correct?
Yes.
And that's really what you want as an investment, as a lending debt fund, is to have that happen. You're going to talk to us a little bit about some of the types of property examples that you've done that are currently in your fund, correct?
Sure. I'll give a few. We did a property in San Jose, a loan that was the second largest owner of commercial properties in San Jose after Google. The borrower had a net worth in excess of $100 million. The loan had an interest rate of 10.9%. This is what allows us to pay our investors close to 10%. In this case, it was a 12-month loan, 6 months prepaid. The reason is because he was going for a big construction loan in 6 months to 12 months to take this it was 6 office and medical buildings and turned them into much higher rise office and medical buildings. So we were kind of this interim financing prior to his big construction loan. Happy to do that. He had already put down $8.5 million himself. Great borrower, great track record, great property. That's an example of kind of a medical office. For an example of residential, we did one in the Hollywood Hills near here. The developer, this was a brand new construction, had already put in $22 million of his own money. He was looking for a short-term loan to just finish up what needed to be done to list it and to keep it on the market. It was appraised at $26 million, and the value that they put it up on the market for was also $26 million. So here we came in, we did another short-term loan just to get into selling it. We were able to charge the borrower 10.9. Again, this is what lets us pay our investors close to 10%. And this had a combined loan to value of 48%. Another example, I've talked about medical and office, I talked about residential. We did a warehouse in Irvine. It housed motorsports, jet skis, water ski boats, motorcycles. And the lady that owned it wanted to do a few things to it to prime it for sale. So she was looking for a short-term loan. She didn't want to get involved with the bank and have a long-term loan. This was a third-party appraisal at $12 million, 40,000 square foot warehouse space, built in 2008. And here we came in again. This was an interest rate of around 10.9. Let us pay our investors 10%. And this had a combined loan to value of about 62%. So you can see, and by the way, these referrals, some came from banks, some came from other lenders, some came from loan brokers. We have no shortage at all of loans coming in. If anything, a lot of people in this space that they either sell their loans because they don't have a fund like we do, but the people in Wall Street right now, due to the COVID, are not buying loans. So all of these loans that would go to all of them are coming to us. So we really get a cherry pick now the best of the best loans. The other folks sometimes will try and match up one loan with one investor. We don't do any of that. We have a fund. Our fund is diversified. It goes across all the loans, which removes risk really mostly from any one particular loan. And that fund that goes across all the loans it gets to then make those payments of it around 10%. But the main thing is we are across numerous sectors. We are trying to avoid the retail sector right now because it's a little soft. But there are a lot of sectors where demand still exceeds supply. And that is residential, multifamily or apartment, medical, senior facilities, storage. There's a number of them, and really that's what it really comes down to, is supply and demand. And right now there's still far less supply than demand for housing and for a lot of other industries, while there may be a little bit more supply than demand in retail. Hopefully that gives you a good feel for the kind of loans we're doing. So now, how are we able to pay this return that you're talking about? Well, there's a lot of reasons that people are coming to us. If the Fannie or Freddie or a bank says that it's below market rent, maybe $100 per unit, or the occupancy should be at 95% based on the market, and they're at 90%, they'll say, go to LK Secured Lending. Get a one-year loan, get it up to market occupancy, get it up to market rent, and then come back to us. So if they know it just needs to be a short-term loan, then they don't want to get involved with a bank or Fannie Mae or Freddie Mac. They charge something called defeasance, which means that if you pay off your loan or you refinance your loan in a short period of time, there's severe penalties involved. So in a lot of cases, I mentioned why some come to us from banks and all of that, but some people just want a 6-month, 9-month, 12-month loan. They want to list a property for sale. They want to do some last-minute type items or what have you. We're happy to do that. Again, as long as the loan to value is there. We're very concerned with third-party appraisal and loan to value. Our fund to date has always been under a 60% loan to value, which is extraordinarily conservative based on these third-party appraisals. And that's why we've never had a missed payment from a borrower. We've never had one. The other thing is there's a lot that goes on behind the scenes. For instance, we do title insurance to make sure that when the title shows clean, that it actually is clean. There's just so many little things. And this is because, as Diana mentioned too, we do a lot of vetting. So really, this is a very safe debt fund that kind of was put together knowing that real estate was at a high price and as a safety play.
This was designed to be able to give you a brief introduction to the company, LK Secured Lending. And I want to thank Barry and Paul and Diana for being here as their co-founders of the company. If you're looking for safety and a great return, there's a contact form just below this video. Go ahead and fill that information out, and we'll have someone get back to you within the next 24 hours. Thank you.